Welcome back, traders. Today we're cutting through the noise. No fluff, no complicated jargon, and absolutely no more drawing random boxes and praying the market respects them. Most traders think supply and demand is about marking a zone and waiting, but that's why they lose, because not all zones are created equal, and if you don't know how to filter them, the market will eat you alive. So today we're diving into the Zone Strength Checklist, the 5 objective criteria I personally use to eliminate 90% of weak, low probability supply and demand setups. These are the same filters that turn messy charts into clean, high confidence trading setups. If you've ever wondered why your zones fail, why some levels explode perfectly while others crumble instantly, or how the smart money decides which areas to defend, this checklist is your answer. And once you apply it, you'll never look at supply and demand the same way again. Right, let's start with criterion number 1. And honestly, this is one traders overlook the most. Is your supply and demand zone sitting inside or near a major psychological level? Because here's the truth. Smart money doesn't randomly choose where to defend price. They have to load up their positions around major round numbers, like 130, 125, 150, because these are levels where buy and sell orders will cluster up, which makes the liquidity much thicker and allows them to enter and exit their positions without impacting the market in a big way. So when your zone forms right on top of one of these levels, the probability instantly spikes. Why? Because now you don't just have a zone, you have a zone plus a liquidity magnet, a level the institutions actively care about, and a level the market has a reason to react to. So if your zone is sitting at a psychological level, the odds shift heavily in your favour. If it's floating in the middle of nowhere, that's usually a red flag and it gets filtered out. So this is the first and most foundational rule, because the strongest zones don't just appear anywhere, they appear where money is already concentrated. Look down at our strongest and deepest zone, right on the 194 handle. This isn't just a round number, it's a macro milestone. Institutions don't place size at random prices, like 194,320 or some other random number. Their algorithms fire off orders at clean, heavy levels. Since this zone is a daily demand zone containing a refined 1 hour zone and is seated directly on the 194 level, that's a double stack of institutional validation, an automatic +2 for our zone. As price pushes upwards, it breaks the 195 psychological level before forming a new demand zone just below the 196 psychological level. While this is a rally-based rally demand zone, which isn't the highest probability zone you can find, the fact that it still sits on the 196 level gives it a much higher probability of working out, because we know that's where all the institutional orders will build up. This gives us another clean, confident +2 score to our zone. And you can also see that the reversal from this zone happened once price struck the 195,500 level. And finally, we reach our highest demand zone, positioned cleanly on top of the 197 psychological level. Even though this demand didn't produce a major reversal due to other factors we'll break down shortly, its alignment with the 197 handle still gives it a full +2 score in our system. In summary, every +2 score you've seen so far comes directly from confluence with a major psychological level. It's never enough to simply mark a zone and then just hope it contains the orders needed to reverse price. Professional trading requires stacking the factors, evaluating structure, psychology, and market context to quantify the probability of a reaction. In this section, we assessed whether each zone aligns with a key O psychological level, and we scored them accordingly. But psychological alignment only tells us where reactions are likely, not how strong those reactions might be. Our next factor changes that. Factor 2 reveals exactly how many orders are sitting at the zone and how they're evolving over time. So, with that foundation in place, let's move on to the next step, orders at the level. Psychological levels give us the foundational reason for a trade, but how do we know the big money is actually interested? Well, we verify our zones using Oanda's order book tool. This factor is about identifying massive clusters of pending limit orders, which represent institutional interest to buy or sell at a specific price. Because if a large collection of orders have built up inside our supply and demand zone and psychological level, then that goes a long way to confirming the zone has real institutional interest behind it. Here's how it works. If a strong, clear concentration of pending orders, either sell limits or buy limits, aligns directly with one of our zones, we'll add another +3 to that zone score. This is the highest score available because it confirms active institutional participation. The key point to keep in mind here though is you must always compare the orders within the zone to the highest concentration of orders on your graph. So always start by finding the highest bars and then check the size of the bars inside your zone. If the bars are roughly the same size as the highest order build-up, that's a +3 to your zone score. If the bars are half the size of the highest build-up, add a +2. If it's a quarter of the size, then that's a +1. Let's look at the order book in a separate panel and check where the massive orders are sitting, then see which one of our zones they confirm. This chart is a perfect example of how the Oanda's order book can be used to confirm the strength and validity of a demand zone, not by guessing, but by seeing real trader positioning inside the zone. Let's look at what the data is actually telling us. On the left side of the screen, inside the demand area, we can clearly see a large cluster of sell orders. These are traders placing sell limits, expecting price to drop, and sell stops, which are panic orders waiting to be triggered. Both types of orders create liquidity that institutions love to exploit. So when you see heavy sell side liquidity sitting inside what you suspect is a demand zone, that's already your first confirmation. The big players want the liquidity to fill their buy orders, and this chart shows that the demand zone provided exactly that. As price drops into the demand, look at what happens. Price taps the zone, the cluster of sell orders begins to disappear, and then price stabilizes and refuses to continue lower. This is institutional absorption in action. The only way price can stop falling and reverse upward while sell orders are being triggered is if there is more aggressive buying than selling. That's exactly what a valid demand zone is supposed to show. As price begins to rise out of the demand, the order book on the right side shows a shift. The buy orders increase, market sentiment flips, and traders begin entering long positions from inside the zone. This shift from sell side liquidity to buy side participation confirms that the zone is acting as a source of active institutional buying. You're literally watching the transition from liquidity grab to accumulation to markup. The order book confirms the story of the demand zone. The combination of the sell orders resting inside the zone, the absorption of those orders, and the fresh buy orders appearing as price leaves gives us a complete narrative. 1. Liquidity was available for the large buyers. 2. Price delivered into that liquidity. 3. Institutions filled their buy orders. And then 4. Price turned and moved away with strength. This is exactly what a real high quality demand zone should look like, not just on the chart, but in the underlying order flow data. The next step is to establish our higher time frame context. I'm on the daily chart for USD Japan, and I'm going to quickly mark up the key supply and demand zones that drove the major moves recently. These are swing points that show clear evidence of large institutional orders came into the market and changed the balance of supply and demand for an extended period of time. So, if price is inside one of these daily zones, it gives your lower time frame zone a higher probability of reversing. For the scoring, we're going to add +2 to any lower time frame zone that's formed within a higher time frame swing point. If the zone doesn't form within a higher time frame swing point, then we're going to add a +1. So now we're going to drop down to our trading time frame, which is going to be the 1 hour chart in this case. The daily zones we just marked provide the magnet or the high probability area where we expect the market to react. We are now looking for a refined or nested zone on the 1 hour chart that sits cleanly inside one of these big daily boxes. Look down here at the lower daily demand zone. As price came back into this area, it created this very tight 1 hour demand zone right at the top of the daily zone. This is excellent. The lower time frame demand zone is perfectly nested within the higher time frame area. It's also positioned extremely close to the 150 psychological level, which we know attract large clusters orders, as I explained earlier. This tells us that the institutional order flow behind the daily zone is found between the top of the zone and the psychological level. So, if or when price returns here, we can use the smaller zone to gain a tighter entry with decreased risk. This means we give the zone a +2 on our scorecard. Take a look at the demand zone above. We have the same setup here as our previous zone, a crisp 1 hour demand zone nested perfectly inside a bigger daily demand zone. In our supply and demand scoring system, this nesting immediately gives us a +2 odds enhancer. Why? Because we have the direction of the higher time frame backing up the precision of the lower time frame. Also, look at where the bottom of the 1 hour zone sits, the 152 psychological level, because we know that institutions love these big round numbers since they act as magnets for orders. So we have daily structure plus the 1 hour precision and a psychological level. But here's the lesson that the market loves to teach us. The market does not care about your limit order. Watch what happens just above our zone. Price drives down aggressively, but instead of tapping our zone and giving an entry, it slams the brakes at 153. See that consolidation right before the drop? The market engineered a fake sell-off to trap late shorts. When price hit 153, it likely grabbed just enough liquidity from early sellers to fuel the price back up, leaving our 152 entry unfilled. Does this mean the zone was bad though? No, it doesn't. The analysis was correct, but the aggression of the buyers was stronger than we anticipated. Now, let's switch things around and look at the supply zone. We see a similar setup but with a critical difference. Here, we have a daily supply zone marked in orange, but unlike our demand example, you won't find a smaller 1 hour zone nested inside. Why? Because the daily zone is the 1 hour zone. Sometimes, the higher time frame momentum is so decisive that the daily zone itself is incredibly compact. When the daily zone is this small, it essentially becomes your execution zone. We don't need to see a nested 1 hour zone to refine our entry because the daily zone is already small enough. It represents a sharp, immediate rejection where sellers overwhelm buyers instantly. Does this lack of a nested zone actually hurt our score though? The answer is no. Since the daily zone is so small, we can just treat it as a 1 hour zone, and the score will remain the same. Right, let's zoom out and look at the battlefield. You now understand the mechanics of two very different trades, the 152 demand zone miss and the supply zone hit. But if you look at your chart, you can see one common factor on every single high probability zone, the +2 score. Every zone you see on this chart, demand or supply, is a low time frame level sitting inside a higher time frame level. We call this the Russian doll principle, and this nesting is the ultimate odds enhancer because it tackles the two biggest problems in trading, context and precision. The context is the daily. The daily zone tells us the institutional intent. It shows us where the banks initiated a major move. If we trade against the daily trend, we are swimming against the tide. So by trading inside the daily, we are sailing. The highest quality move away is what we call a vertical takeoff. This occurs when price leaves the zone aggressively with large consecutive candles of the same colour, covering a significant distance without any major pullbacks or small candles showing hesitation. A vertical takeoff indicates a high degree of urgency from the institutions, meaning they filled their orders and immediately drove price far away. This leaves behind a lot of unfilled orders, making the zone very strong. The lower quality move away is what I call the slow crawl. This happens when price leaves the zone slowly, characterised by small candles, overlapping price action and a lot of wicks indicated indecision. A slow crawl suggests the move was less urgent. There was less conviction from the institutional traders, or perhaps they had difficulty moving the market, resulting in smaller, less significant order imbalances left behind. This makes the zone weaker. Let's look at the first example, this supply zone on the far left. We mark the zone and then we immediately observe the reaction. What do we see? We see price falling like a stone. Notice the size of these bearish candles. They are large, decisive, and they close near their lows. There's no hesitation, no lengthy consolidation, just pure aggressive selling pressure. That means the institutions dump their positions here with conviction. This aggressive drop confirms that a massive imbalance of supply was introduced, which completely overwhelmed the previous demand. We call that trapped momentum. When price moves this quickly, it means a significant number of market participants, the late buyers, were caught off guard and couldn't fill their orders until much lower prices. This leaves a vacuum that price will often return to fill. This is the institutional footprint we're looking for. This dynamic means we have increased confidence in this zone holding again when price inevitably returns. Let's focus on the first demand zone on the left. Price drops into the area, and what do we see? A period of sideways accumulation. The candlesticks compress and trade in a tight range. This is the market digesting the remaining supply. The eventual push out, while not exactly a slow crawl, is noticeably smaller and less explosive than the vertical takeoff examples we've seen already. Because the exit lacked that explosive high momentum signature of institutional intervention, we assign this zone a +1 score. The demand here was strong enough to reverse price, but not aggressive enough to launch it vertically. It confirms the zone's validity, yet limits its overall strength rating. Now, let's look at the second box zone on the right. This pattern is a textbook definition of a slow crawl. Price enters, stabilises and consolidates for an extended period, suggesting patient reaccumulation by institutional buyers. The move away is once again slow and methodical, a controlled measured climb rather than a sudden breakout. This is our second clear example of a small crawl away, earning another +1 score. The takeaway from this kind of price behaviour is simple. Institutional demand is present, but not urgent. They're entering but doing so quietly, without drawing any attention to themselves. This tells us something critical for future planning. When price eventually revisits these zones, we should expect measured buying pressure, not an explosive reversal. Always remember the visual distinction. A small crawl away means a demand is strong but restrained, a solid +1 score. A vertical takeoff reflects urgent institutional imbalance, giving us a +2 score. These two examples perfectly demonstrate how grading the momentum of the exit reveals the true conviction behind each zone, and why it's one of the most critical factors in evaluating zone strength and probability. For our final factor, we're going to look at zone takeout, and the question we ask here is simple. Did price break the next nearest opposing supply or demand zone? Let's set the scene. So at the lower level, we have a newly formed strong demand zone, the potential source of buying power. Immediately above it, we have the nearest obstacle, the supply zone. This supply zone represents the next area where sellers are awaiting to defend their turf. Watch the move originating from the lower demand zone. Buyers step in and drive price upwards. Critically, they don't just bounce, they maintain momentum and power right into the opposing supply zone. The price action is aggressive, pushing straight through the boundaries of the zone. Utterly overwhelmed and effectively taken out of play. This confirms our rule. Price took out the next nearest source of supply. Why is this so important? Well, when a demand zone initiates a move strong enough to entirely break the nearest source of opposing supply, it's another validation of institutional strength. It tells us that the liquidity injected into the demand zone wasn't just enough for a small profit-taking bounce, but was large enough to structurally change the market by neutralising the seller's stronghold above. If we look at this chart, we can see a perfect example of how a valid demand zone proves itself by removing the nearest opposing supply. Let's break down exactly what happened. At the top left, we have a clear supply zone marked in orange, the source of the most recent selling pressure. This is where sellers previously stepped in and pushed price down aggressively. It's the closest opposing zone above the green demand. For demand to be considered strong, it must show that buyers are willing to overwhelm the sellers located here. As price drops into the green demand zone, we see multiple rejections and a tight consolidation. This is the footprint of professional accumulation, slow, controlled buying from an area where institutions previously placed orders. Nothing dramatic yet, but the intent is building. Then we get the key moment. A sharp, impulsive rise launches upward from the demand zone. This isn't a small crawl, this isn't hesitation, this is a clean, vertical displacement, exactly what institutional buying looks like. This move shows a strong imbalance, eager buyers, a willingness to absorb all available sell orders, and zero interest in hanging around. This is the type of departure we want to see from a high-quality demand zone. As the move continues, price ramps straight into supply, and instead of reacting down, the market breaks right through it. This tells us two important things. Number one, sellers at the supply zone failed, their orders were absorbed. And two, buyers from the demand zone dominated. They had enough volume and aggressiveness to consume all the remaining sell orders, push through the resistance, and invalidate the supply zone completely. Once a supply zone is removed, it's no longer a source of active selling. That's the textbook. So that wraps up our deep dive into scoring supply and demand zones using real objective criteria, not guesswork, not hope, and definitely not the textbook myths floating around online. Now you understand how each factor contributes to a zone's probability. Psychological levels, these are the round numbers where human behaviour will cluster and show the orders. Oanda's order book, which is the real positioning data, so we can see where traders are actually trapped or committed. The strength of the move away, not just the size of the candles, but the imbalance behind them. The higher time frame containment, so whether your zone is sitting inside a larger, more dominant institutional zone. And finally, whether the zone removed the next opposing zone, which is one of the clearest signs of real institutional intent. Individually, each of these factors tells you something, but together they give you a complete framework, a scoring model that removes emotion, reduces randomness, and helps you trade with clarity instead of hope. Remember, no single factor guarantees a winning trade, but when multiple factors line up, you're no longer trading noise, you're trading structure, intention, and the psychological footprint of the market's biggest players. In the next section, we'll take all of this a step further and how to stack